Hey, I'm Selena with the NEA Home Team of Image Realty, and it's Feature Friday, and I am back with David Norris at Arvis Bank. Sorry.
That's all right.
And so we kind of talked about interest rates, forbearance, that type of stuff last time. This time, kind of take us through the pre-qualification process and the types of loans that are available.
Sure.
Because, when people call us, they want, hey, I want to look at a house, and we're like, are you pre-qualified? What does that mean?
Absolutely, and this is where working with a local lender that you trust, that you've got a great relationship with, is very, very important.
And local lender.
we've been emphasizing local here for a couple of weeks now, but that's a big thing. Is work with a local lender that you trust, that you can rely on, that you can pick up the phone or go see them in the office if you needed to.
Or reach out and touch.
Oh yeah, or reach out and touch. That's exactly right. The loan programs are. Every mortgage lender, for the most part, does the same type of loans. You have your conventional loans, your FHA loans, your rural development loans, your VA loans for our veterans. And then depending on, some lenders have more than that. Some have in-house lending that may require certain parameters. For example, we have a physician loan product that's just for physicians, doctors. Could also be incoming doctors that are going into residency. So it's all about understanding the needs and objectives, and that's a big part of what our loan officers believe in developing a solution, developing a scenario that fits your goals, your budget, and your objectives for the transaction. But we want to talk a little bit about that your credit scores. Close. That's what depends on the interest rates. Your credit scores depending on your interest rates. But the interest rates, there I did it again. Your credit score on your conventional mortgage loan, we require a 620 credit score on a conventional mortgage loan. Now that may vary from lender to lender, but we require a 620 credit score for your standard, traditional, conventional mortgage loan.
Okay, and what's the down payment on that?
So a down payment on that is anywhere between 3 and 5%. Better advantage if you're a first-time home buyer. That offers a little bit more flexibility. First-time home buyers can do as little as 3% down on a conventional mortgage
Really?
loan. Yeah, absolutely. Yeah. And several, and then the most common is 5%. Now the interest rate's a little bit higher on a 3% down. Also, you're going to pay a little bit more in private mortgage insurance, which is that pesky insurance policy that's built into the payment when you don't put down 20%. So 3 or 5% down is your more common scenarios for a conventional loan. FHA, 3.5% down. Minimum credit score for us that we require is a 620 on FHA as well. Now FHA, I believe, we don't do it, so I don't know it right offhand, but I believe they'll go down to 580, and some may even go lower on an FHA loan. Again, speak to the lender, speak to the loan officer that we're talking about. They're going to know the answers to those credit score questions. Rural development, 100% financing for properties located in a rural area. 640 credit score is the requirement that we have for rural development. And then one of the things that you and I kind of talked about off camera was the income eligibility for rural development.
Yes.
Here in Craighead County and the surrounding areas here in Northeast Arkansas, the household income limits for a 1 to 4 member household, 91,900 is your household income limit. If you make over that and have a 1 to 4 family home, then typically is not going to be eligible for that. And so again, speak to your local loan officer about what those options available are. VA loans, great 100% financing product for our veterans. We require a 620 on that as well. So across the board, minimum 620. Rural development does require a 640. So that's a little bit about some of our products. Pre-qualification really is the look at your, have your borrower or you all watching at home, filling out a loan application with your loan officer. What we'll do at that point is we're going to take a look at your credit. We're going to take a look at your income, your assets, and most of the time those are actually just off of your stated income or assets. Just to kind of get us in the door to see where we need to be. Sometimes, income situations are trickier than others. Self-employed income borrowers can be very tricky. Commission, very heavy commission or overtime-based Employees can definitely pose a little bit trickier of a scenario. But work with your loan officer to find the best solution that works for you. But like I said, we're going to look at your credit, your income, your assets, the purchase price you're looking at, maybe a payment that you're comfortable with. We want to make sure that the payment that we're pre-qualifying you for fits into that budget range. But also we got to consider, do you have money available for the down payment? Do you have money available for the closing costs that are associated with it? Right now we're in a seller's market. I don't want to take your thunder, but negotiation is almost gone now. Right? So we're in a seller's market where the price is oftentimes what it is, and there's very little negotiation involved in that. So we all have to prepare for those contingencies. And then really the next thing, once your loan officer say, hey, we got you pre-qualified based off of this information you've given us, that's when that letter comes out, goes to you, and the house search begins.
Okay. So now you also look at debt to income ratios.
Absolutely,
too.
yeah.
Okay, and then let's talk about shopping for a loan. A lot of people don't know that you can do that. They think that, well, if I start here and do 2 or 3 places, that's going to hurt my credit score, and every time it takes a ding, it goes down.
Right. That's it's a common misconception that if you're shopping mortgage lenders, and if you actually do a loan application with them, they're going to pull your credit with your authorization to do so. But if you're doing it in a short period of time, there is a buffer in there. Depending on the credit bureau data that you're looking at, but on buying a home, it's usually 30 days or less if you're doing those inquiries together. It's only going to count one time. That's the way that the algorithm, the credit scoring algorithm, is being built or was built, and it's designed to protect the consumer as they shop around for the best home loan product. Now, you can call any mortgage lender, and based off of stated information, they can probably produce an interest rate, an APR, estimated costs, and things of that nature. But these are the things that as we talked about already, is the shopping with a local lender. There's and I'm not talking about just a bank, but there's a lot of local mortgage companies as well. So a local banker, a local mortgage lender, and a local mortgage banker at a mortgage company. Like we said, we joke, you can reach out and touch them. You can go see them in their office. You can pick up the phone and call them. You're not calling a call center in Detroit or on the West Coast, or you're dealing with someone that's in your community.
Which is very, very important when it comes to one of the biggest purchases of your life. You want somebody there to kind of hold your hand and walk you through it.
That's right.
Say, you need to do this, or you need to do this.
It's very important for us
especially if there's a problem. Especially
if there's a problem. That's right. Hopefully we don't have very many of those, but no, you're right. We want our mortgage bankers to be in and around the community in which they serve in. That's a big part of our belief system in our culture. So that's, like I said, the local lender is your friend, and there's a whole bunch of. We got a great group of loan officers here in Northeast Arkansas that can take care of basically any situation.
Okay, so let's talk just for a minute about Helocs and bridge loans.
Yeah,
because a lot of people really don't know what that is.
Yeah, the big one here is the bridge loan, because that can be used, and it's the bridge loan. It means you can bridge your equity, bridge your liquidity from one property to another. And there are various banks and companies do bridge loans a little bit differently. You can take equity out of your current home and use it to fund the down payment and closing costs on your new home. And then once you sell your current home, that bridge loan goes away. You can do a bridge loan where there's only one mortgage on one property, or you can do a bridge loan where there's a mortgage on both properties. And so that's just a great way to utilize the equity. The entire concept is being able to utilize your equity in your current home to fund the down payment or whatever it is that you need it for.
And that came in very handy, especially this year in this seller's market, because a lot of sellers are like, I'm not going to take a contingency offer.
Yep.
And so bridge loans, I bet, were really big this year.
Definitely. And the other thing too is that we've seen so many houses appreciate in value that there was more equity in their home now, because of the market supports that, than there were when they bought the home. So that's something that people are able to take advantage of too. Now, home equity lines of credit typically aren't used to buy homes, but we see folks use Helocs to do remodeling. Big thing for us is home improvement. We've got home improvement loans that are specifically designated for that. We've got some loans that are home improvement loans that aren't even a mortgage. They're unsecured, but they're used for home improvements. So it just really kind of depends on what you're trying to do with the HELOC. And the HELOC is a great thing. We see a lot of people do HELOCs for remodeling, as you said, updating, huge. Pools.
Yes.
Pools are a big thing.
Were a really big thing this year.
Absolutely. That's a very common request that we get for HELOCs. And we've had some people, the great thing about HELOCs is you're tapping into that equity that you've got. We've seen people, believe it or not, you can buy a car with a HELOC. You're using the equity. It just depends on the scenario, weighing your pros and cons. But the HELOC is a great way. At the end of the day, HELOC is a great way to access the equity that you've got in your home.
Yeah, awesome. Well, I would like to thank you very much for taking your time.
Thank you for having me on.
Discuss all of this information with our audience, and hopefully you will find that helpful. So stay tuned next week. You never know where we're going to be. Thank you.